Okay, so let's give a quick update on the situation that we currently have on the S&P 500 index. Now, let's start from the weekly time frame. Now, last time that we spoke about the S&P 500, what did we say? We said that clearly from a weekly perspective, we have very strong resistance at this zone. In fact, just before the crash that we all know that happened, whereas the last time that the market created a move to the upside, the last time that the market went to the upside before the crash is exactly from this low, where the market made this wave to the upside before crashing to the downside. So this is the previous support, which is now turned resistance at this area, and the market already respected it, and again turned resistance at this area, and the market we definitely expected to respect the area. And in fact, from a daily perspective, what did we actually also say? We said the market clearly has created also this W formation, and we want to see a retracement to the neckline before the continuation. And in fact, that is what the market has done. However, now the structure obviously has changed, so we have to adapt to this new structure. So let's make the full breakdown starting from the monthly time frame to understand where we can be looking for the next trading opportunity on the S&P 500 index. Now, just 1 second, because it seems like the chart is stuck. Okay, so what do we have starting from the monthly time frame? Now, as we have seen previously, we have the huge impulse to the downside. Now, if we want to measure our retracement in the market, what are we supposed to be doing? Taking our Fibonacci from the high to the low of the impulse. And we can see that the market currently is above the 0.786 from a monthly closing perspective. However, keep in mind that the last monthly close has been below the area, and we have more than 18 days still to go before this monthly candle will close. What does it mean? It means that we expect sellers to actually try to protect this 0.786 and actually create a monthly close below the area. So we can expect some selling pressure from a monthly perspective. Going down on the weekly, as we have previously identified, we clearly have structure at this area, and we expect the market to respect it. Going down on the daily, situation is very simple. We know that from the monthly and weekly, we want to see a move to the downside. However, we must notice that on the daily time frame, all structure is bullish, with the previous resistance here now turn support still holding. So monthly and weekly, we want to see a move to the downside. However, on the daily time frame, we have support and a bullish structure. So how can we approach this situation? Now, before I show you how we can approach this situation and how we will be approaching the situation with students, let's first go and give a quick check at what we have from a COT perspective. So commitment of traders, what the biggest banks and institutions are currently doing in the market, specifically on the USDJPY, because as you know, USDJPY correlates very well with the S&P 500 index. So we can go and check what they are doing on this pair to actually understand the situation. Now, keep in mind that all currencies on all currencies on the spot are traded against the USD, meaning that if you check the data for the JPY, what you're actually checking is JPY USD. So if you want USD JPY, you just have to reverse everything. And what we can see is that we went from a situation where we had minus 56K net positions, so way more shorts than longs, with 110K shorts and 53K longs, to a situation where we had way more longs than shorts, so completely opposite scenario, with 57K longs and 23K shorts, to a situation where again net positions decreased all the way down to 16K net positions with 44K longs and 27K shorts. So overall, we see an increase in the shorts lately with this decrease, but in the long term, we have seen definitely a JPY USD getting stronger, meaning USD JPY getting weaker, meaning that we can expect the move to the downside on the S&P 500. But it's very, very important to say that, as usual, trading is reactive, not predictive. So we cannot be looking for any shorts until we will see a clear break of daily structure. Until everything will remain bullish from a daily structure perspective, the market can and should continue the movement to the upside. But if the daily time frame will actually manage to break the structure, so create an impulse to the downside that breaks from a daily closing perspective this structure here, at that point we have the daily structure previous support, which is turn resistance. So we have the monthly that is bearish, weekly that is bearish, daily that is bearish, so everything showing the same direction. And at that point, that is where you have the best probabilities and best risk to reward, which is exactly what you have to look for as a trader. And with students, what we will be doing, we will be monitoring price action on the 4-hour time frame inside of this area, waiting for the market to provide to us one of our valid entries. And as soon as the market will provide to us one of our valid entries, we will be taking a nice short with a very good risk to reward and very good probabilities for the move to the downside and for the market to go and test this very strong support that we have here, which is the structure, resistance here, support here, which is a very strong demand area that we expect the market to go and test for the completion of this impulse correction and impulse pattern to the downside. Now, if you enjoyed this free analysis and education, make sure you drop a like and a comment. It really does support the creation of more free education and analysis for all of you, and I will see you in the next video.